Okay guys, so if you've been thinking about buying a home, refinancing, or you already own a home and you're watching what's happening with mortgage rates right now, this video is exactly for you. And I need you to pay close attention because things have moved very fast. Just back in March, the 30-year fixed mortgage rate had dipped below 6% and people were starting to feel hopeful again. I know I was, and I thought the housing market was going to change. But unfortunately, that progress is completely gone. Just as of this week, the 30-year fixed rate has now surged to 6.55%, and that is the highest level since last summer. And the 30-year refinance rate has jumped all the way to 7%. Now, before I dive into more details of this video, in case you're new around here, my name's Nima and welcome to the channel. I'm a corporate executive with over 15 years of experience in both sales and finance. My videos break down complex financial concepts to help you on your financial journey, whether you're just starting out or if you're already a seasoned pro. So guys, let's jump into today's video topic, which is the housing market just collapsed due to soaring mortgage rates. Now guys, I need you to stay with me all the way to the end of this video because I'm going to answer the one question that everybody's asking right now: when are mortgage rates actually going to come back down, and what that answer means for your decision making as a buyer or a seller or a homeowner right now. So seriously, don't leave before we get there because that's the piece that ties everything together. Alright guys, so without wasting any more time, let's dive into it. Now, let's start with the most important question. Why are mortgage rates shooting up this fast, and why did all that progress from earlier this year just evaporate so quickly? Well, to understand that, you first need to understand one key relationship. Guys, mortgage rates are directly tied to the interest rate on 10-year Treasury notes. When Treasury yields go up, mortgage rates go up along with them, almost without exception either. Right now, the 10-year Treasury yield has climbed to 4.645%, and that is what's putting massive upward pressure on what you pay to borrow money for a home. So then the next question is, why are Treasury yields even rising? And the answer then comes back to the same thing that we've been talking about for months on this channel. Guys, the war in the Middle East and what it's doing to oil prices and inflation expectations is the root cause. And here's how it connects. The Strait of Hormuz, the narrow waterway that about 20% of the world's oil passes through, has been severely disrupted by the Iran conflict. Gulf countries that produce oil are selling less of it, which means that they are receiving fewer dollars, which means that they have fewer dollars to recycle back into buying US Treasury bonds. And at the same time, countries that need oil have been selling their Treasury bonds to get dollars required to buy oil on global markets. Both of those dynamics, less buying and more selling of treasuries, pushes treasury prices down and the yields up. And on top of all that, when oil prices surge, inflation expectations across the whole economy go up, and bond investors demand to be paid higher interest rates to lend their money to the government. And guys, all of that information combined is why mortgage rates went from below 6% in March to now 6.55% this week in what felt like in a blink of an eye. So now let's talk about what this rate surge is actually doing to the housing market in real time, because these consequences are already showing up in the data. So for the month of April, home prices nationally rose to 0.2% month over month and a 2.1% year over year, meaning home prices are not crashing, but they're clearly slowing down. Homes are taking longer to sell, bidding wars have cooled significantly, and inventory is actually rising as buyers step back from the market because they simply can't afford these monthly payments at these rates. And here's the thing that most people don't fully appreciate. The monthly payment difference between a 6% mortgage and a 6.75% mortgage on a $400,000 loan is about $200 a month. Guys, that's $2,400 a year. And another example, on a $600,000 home, it's even more dramatic. So you can understand that as the homes even rise up to $1 million or more, it becomes even more dramatic. So guys, it's not just a number on paper. It's real money that's qualifying fewer buyers, pushing people out of price ranges that they were just in 3 months ago. And that's forcing sellers to adjust their expectations. Mortgage delinquencies are also rising, but I want to give you some important context on that as well. Yes, delinquencies prices are rising, but we're starting from a much lower base than we were before the last housing crisis. We're nowhere near the levels that would indicate a crash is coming. The market is slowing down and getting more difficult for buyers, but those are two very different things from a collapse. The bigger concern isn't a crash, it's the affordability, which was already at a historically terrible level, which just got meaningfully worse in a very short period of time. Now, guys, before I dive into more of why the housing market has a new problem, and that's the surging mortgage rates, if you're gaining value from this video, I'd really appreciate it if you could smash that like button, leave a comment down below, and subscribe. Your support helps this channel grow, so please show some love by smashing that like button, commenting down below, and subscribing. Alright, now let's discuss the next segment. So now I want to go a little bit deeper here in this video, because there's a layer to what's happening with mortgage rates that almost no one is talking about, and it connects directly to how the global financial system works. There's a system called the petrodollar system, and it has been the backbone of global finance for decades. Here's how it works in plain language. Oil is traded globally, and the vast majority of that trade happens in the US dollars. So, Gulf countries sell their oil, they receive dollars, and then a large chunk of those dollars gets recycled back into the US financial system, specifically buying US Treasury bonds. When Gulf countries are flush with oil revenue, they're essentially lending money back to the US government, which helps keep Treasury yields lower and therefore keeps mortgage rates lower. But right now, because the Strait of Hormuz is disrupted, less oil is moving, those Gulf countries are making fewer dollars. That means that they have less money to put back into the treasuries. And when the biggest consistent buyers of US government debt step back, yields have to rise to attract other buyers. And rising yields means rising mortgage rates for every American trying to buy or refinance their home. And guys, unfortunately, this is why what's happening in the Middle East is not just a geopolitical story. It's a personal finance story for every homeowner and potential buyer in America right now. The war didn't just push gas prices up, it fundamentally disrupted the global financial plumbing that helps determine what you pay on your mortgage every single month. So now let's get to the question I know everyone watching this has been waiting for. When are mortgage rates going to come back down? And what you should be doing right now based on where things stand today. And the honest answer is that it depends almost entirely on how the Iran conflict resolves. And nobody can tell you that with certainty right now. If the war de-escalates meaningfully, oil prices come down, inflation expectations cool, treasury yields ease, and the mortgage rates will follow. Housing economists have largely abandoned their predictions of rates falling below 6% anytime soon. Both Fannie Mae and Mortgage Bankers Association now project rates hovering between 6.3 to 6.5% throughout the rest of 2026 and into 2027 under a best-case scenario. Morgan Stanley has also suggested that rates could potentially dip to 5.5 or 5.75% mid-year if the Treasury yield stabilizes, but they also warn of another move higher toward the end of the year. And guys, in the worst case scenario where the conflict escalates further, some analysts are warning that mortgage rates could even push towards 7.5 or even 8%, which would effectively freeze the housing market at a level of unaffordability not seen in decades. And there's also this scenario where the Federal Reserve steps in and directly buys Treasury bonds to bring the yields back down. But that move would likely spike inflation even further, which would push home prices even higher. So guys, ultimately, it's a difficult box to be in, and there's no clean answer right now. What I can tell you though is that the people who got locked in under 6% in March are sitting in a very valuable position right now. And if you're currently in the market trying to make a decision, patience and financial discipline are going to be your most important tools. Okay guys, so here's what I want you to take away from all of this in terms of a practical action, because understanding what's happening is only half of the value in this video. If you're a potential buyer right now, the most important thing that you can do is get crystal clear about your monthly payment budget at the current rates, not the rate that you were approved for in January or not the rate that your friend locked in last year. I'm talking about the rate today. And make sure the home that you're considering is genuinely affordable at that number with some room left over. A lot of people are making the same mistake of stretching to their absolute maximum qualification limit at 6.5 or 7%, which leaves zero cushion if anything in their financial life changes. Please do not do that. If you already own a home and have a rate above 7% from a previous refinance, keep watching rates, but understand that the environment for refinancing right now is not favorable, and forcing a refinance in this market could cost you more than just simply waiting. But if you do own a home with a rate below 5%, do not let anything pressure you into giving that up. That rate is genuinely an asset in this environment, and one of the reasons that existing home inventory remains tight is because people with low rates are locked in and they're not moving, they're not selling. And the bigger picture message that I want you to walk away with is this: the housing market is not crashing, but it is genuinely becoming more painful for the people who need to participate in it right now. The solution to that is not panic, it's patience, financial preparation, and making sure that your monthly budget is built around today's reality, not the reality of a year ago. And that's it, guys. I appreciate you watching this video all the way through. Please make sure to subscribe so you don't miss the next videos that I put out every other day. I always talk about mortgage rates, interest rates, and what we're expecting to see in the next coming months or even years. And please drop a comment down below. Tell me what your mortgage rate is. What were you able to lock it in at? What percentage did you get? And tell me what your monthly payment is. I'm just curious to know what the average is looking like, to see if some of my viewers are really struggling at this time or at least getting by. I genuinely read everybody's comments and comment back. So I appreciate you watching this video all the way through. I'll see you guys in the next video.